So let's run through how to position your portfolio. I have 8 ideas for you. Okay. Some are more relevant to you, some are not so relevant to you, because every one of us have a different context. Okay. So the problem with answering this kind of question is that I don't know your situation. So whatever I say may not apply to you. You have to make your own assessment. So that is the warning I want to give you. You cannot take it as everything I say, you just accept it as the truth. Okay, it may not be suitable for your situation. So please think for yourself. Okay, take reference to what I say, but think for yourself. Then you decide. Most importantly, if you ask me, please find your sanity. Okay, before we even talk about how to position this and that, please find your sanity. Okay, no health, no wealth. I don't know who say one. Okay, so I say this is my quote. So remember, no health, no wealth. Because if you keep worrying about your position, wow, this and that, right, then your health deteriorate, right? Then what's the purpose? Okay, might as well invest in something that you don't need to worry about that much. Okay, so remember this very first thing. Okay, if you are worrying too much at this point in time, it is unhealthy. Okay, I need to point it out, not just for your mental illness, because it can also affect your physical health. Okay, you can fall sick easily, blah, 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 right? So it's not worth it one. Okay, you don't want to be sick and rich, correct or not? Okay, so you rather be healthy, and as long as got money to spend, good enough, right? So don't trade your health for your wealth. Okay, very important. If you are worrying too much, please cut down your position. Okay, sell down some of the risky things that you're doing that's keeping you awake at night. Okay, I cannot stress that more enough. Okay, so I give you an example. This book covers a lot of the physics changes when you deal with the markets. Okay, so one thing I just want to point out for you, just to let you know why I emphasize on this health part, because you might not even know that you're being affected by the markets. So you might think, it's okay, it's okay. But actually, at the background, you are, because you cannot control your hormonal changes. One thing is that volatility of the market goes up, right? Your cortisol level goes up. Okay, and it's not like our ancestors where they meet a danger like a tiger, then you run away, then that whole episode is very short one. Okay, or you don't run away also, never mind. Water under bridge. Okay, so the cortisol level spike and then you just retreat. So it's supposed to work like that. But in our high stress environment, right, especially when we do markets, right, you keep getting involved in the market, right, you will develop a very chronically raised cortisol level. This is one of the key problems. Okay, that means that your cortisol level, right, instead of spike and come down, it just keeps staying at a very high level. It's because the body use it to manage stress that you are feeling. And this is something that you don't even know. You don't know your cortisol level unless you really measure it. All right. And this cortisol level, when it's too high chronically, it can develop into type 2 diabetes. Okay, that's just one of the many effects, okay, of all your hormonal changes, how you deal with market stresses. And I think that it goes beyond just market stresses. I think our lifestyle, the city lifestyle, the stress and pressure that people get every day is what causing, Singapore has one of the highest diabetes rates, right? I think it's related to these stress levels. I think it's related to this cortisol level. So please, if your work or your business is already very stressful, don't go and add yourself with more stress in the markets. Okay, so do something that is healthier for you, right? So that is some advice that I want to give to you. So this is a very first thing that I want to share. Okay, to help you also to look at your position, to let you worry less. Maybe that can help you lower your cortisol level, right? Is that you look at your overall wealth, right? Look at your whole entire wealth. It might not be that bad, because if you focus only on your stock portfolio, right, it might look bad. Okay, because the market has been very bearish, right? You lost a substantial amount. Okay, but if you zoom out and you look at your overall wealth, it might not be that bad. Okay, so this is the latest Singapore household balance sheet. This is the average of what a typical Singapore household asset allocation look like. You can see about 40% is in the house, which is not surprising because Singaporeans mostly own your house, right? Okay, and then there's a good 20% in cash, because Singaporeans are good savers. And then another 19% in CPF. The surprising thing is that only 4%, about 4% of the wealth is in stocks. So let me ask you, if this is your allocation, should you be worried if the stock market go down 50%? If you only allocate 4% of your assets into stock market, and let's say the stock market crash 50%, should this be something worth worrying about? What do you think? Maybe some of you cannot lah, drop, lose $1 also cannot. Okay, I don't know how to answer. If you ask me, don't focus on the wrong thing, right? Because if you look at overall wealth, I would think that most people unlikely to put a lot of money in stocks. Okay, the exposure is actually already much reduced. So don't worry for nothing. Okay, so this is to help you change your perspective. Okay, I'm not saying that losing money is okay. I'm just saying that if it can help you alleviate your stress, that's one way to look at things. All right. There are some other things that you can look at, okay, especially if you are still employed, you have a salary that's coming in, okay, then you can keep investing, and you should be keep investing rather than be worried about your current position. Right? Your cash flow is not hurt. You don't need your investment portfolio for a living, right? So it's not end of the day, okay, not end of the world. And even if you say, oh, but I'm not young anymore, maybe I'm 40 years old or 45 years old, right? You still have like 25 years, 20 years of investment horizon, it's not short. Okay, it's not a short time, right? And now, you talk about your median death age is like probably closer to 90 years old. Okay, times have changed, right? So which means that your investment horizon actually lengthened, not shortened. Okay, so you have more time to recover, right? And maybe some of you focus on dividend stocks, right? Then you don't look at the capital gain and losses. You focus on the dividend, the cash flow that you get. If the business are still making money, giving you the dividends that you invested for, there's nothing to worry. Right? So what I'm trying to say is that there are a lot of things that we worry for nothing. Okay? One of it is your portfolio. Okay? So if that can help you reduce your stress just by changing your perspective, I think that has gone a long way. Okay, so that's the first point. So now let's move on to what can you do with your investment. And I want to break it down in different kind of scenario, right? Some of you have cash, additional cash to deploy. Okay, like what we saw just now, the average household asset has like 20% of their wealth in cash. Okay, 4% in stock, a lot of cash to deploy one. All right, so that is the first scenario. Then second scenario is that some of you maybe, wow, I fully invest already, no more cash already. Okay, I fully invest. Okay, so then what can you do? So let's go through some of this scenario. So if you have cash and if you are doing dollar cost averaging religiously, right, all the time, then the suggestion is that you should continue to do dollar cost averaging. Don't stop. Okay. Then that comes the point that people will start to compare. Should I do dollar cost averaging or should I do lump sum investing? Okay, very common question. Correct. Should I just split it up since I got cash? Should I slowly buy or should I just buy everything at once? Okay. What does the stats say? The stat says that, most of the time, lump sum will do better than dollar cost averaging. Okay, how to read the chart? This is a 0 point. This line in the middle is a 0 point. If this graph is below this 0%, means the lump sum do better. If the graph is above the line, that means DCA do better. Okay, so you can see actually most of the time your lump sum do better. All right, but don't get stressed over this. Okay, don't say, oh, then I must put as much money now as possible. Okay, you will get stressed also. So don't. If you have been doing DCA, just continue doing your DCA, monthly buy into don't know what you are buying, ETF, unit trust, whatever, right? Just continue, don't stop. Okay. In fact, this is the reason why you should not stop. Okay, and also take the time to explain why most of the time lump sum investing works. Okay. I give you a good example over here. Let's say choice A, you put $10,000 right at the start here. Okay, choice B, you split into 5 times 2,000 each. Okay, which one do you think will make more money, A or B? A or B? Who will make more money? A, right? Okay, correct, obvious. Now let's do the other option. Okay, Let's put in C. Put in 10,000 here. And then D, split into 5. Okay, 2K each, same. Between C and D, who will make more money? Actually, both lose money. Who will lose less money? D will lose less money, right? Obviously, right? Okay, this is not a trick question. I'm just trying to show you the logic behind this. Okay, so why do lump sum investing? Because we know that, okay, A is doing lump sum investing here, right? And D is doing dollar cost averaging here, correct? So why does lump sum investing, like what we say just now, why did lump sum investing work most of the time? Because most of the time the market is on a bull run. 2/3 of the time market is going up. 1/3 of the time the market goes down. So just remember, your DCA only beat lump sum if it's going down. So in a bear market, especially if you believe that it's going to continue to be a bear market, you must not stop your dollar cost averaging. You must continue, because this is the only time that you will beat a lump sum investing. If you don't do it, you prefer to do it when the market is going up, right? You might as well invest everything upfront. You make more money that way. Okay, so the logic is not difficult to understand, right? But I think the emotional part is very hard to overcome, because it's very hard to buy when the market is going down. Because after you buy, the market goes down, you say, I know the market going down, I should have waited, correct? But you don't know where the bottom is. So the better way is you just keep buying. Don't give up. Okay. By the time later it rebounds, oh yeah, rebound already. Then you start buying. Then you dollar cost averaging in. Wow, worse. Okay. You do worse than the lump sum who just throw everything here. Yeah. So you get what I mean, right? So you should continue your DCA, your dollar cost averaging. Don't stop. Okay. Especially during a bear market, you should not even stop. Okay. Just continue. And most of us will always do DCA, right? Because you don't get all your money, your lifetime, let's say you work for, I don't know, 40 years. Okay, you only receive your salary, your income, which forms your capital, right? In a DCA method, even your employer DCA you, correct or not? So likely no choice, you have to DCA into the market, one. Okay, you don't get upfront all your salary at the start of your employment, right? It's not possible. Okay, most don't, right? Unless you have inheritance. Okay, otherwise most people will DCA. So it's a matter of having a capital. So if during a bear market, you better continue, don't stop, just keep buying, right? So bear market is better for DCA. Okay, so if DCA, likely you are doing money investment plan, whether is it to ETFs, whether is it unit trust, you may be investing through your advisor, you may be investing through brokerage account, or you may be using a robo advisor. Just keep going, don't stop. If you need the encouragement, here is it. Here I'm giving you. Please don't stop. This is not the time to stop. This is the worst time to stop as the market is going down. Right? Third way, okay, if you have like waiting to deploy lump sum one, okay, you're not really doing DCA one, right? Buy the dip. Okay, buy the dip, especially when the market has dropped like 30%. Okay, as a whole, the index, not the stock, the index. When the index is down 30%, right, and you buy, right, the chances of you making annual return of like likely you'll make like 5 to 10% per year. When the market is down 30% and you buy, likely going forward, your average return most of the time is between 5 to 10% per year. Okay, all right. Won't know when is the dip. Then when it go down 30%, right? So yes, it can go down 30%. Then after that, go down another, I don't know, 20%, possible. Okay, but the chances of you buying, yes, you suffer a dip, the rebound comes, you will still make more than what you will do. Okay, so if you have lump sum, when the market come down, better buy. And if the market, the index drop 50%, better buy already. Okay. Yes, it can go -60, -70. It doesn't matter. Very near the bottom already. All right. And if it doesn't recover, right, I think it's end of the world. So it doesn't matter. Okay. So just if by 50% you don't all in, I don't know you keep the cash for what. Okay. Right. So indeed, maybe 71% of you believe that the bear market is here and this is just a dead cat bounce, and it really went all the way to minus 50% from the top. Okay, just buy with all your intended capital to deploy. Just go in already. Don't wait already. Because I know a lot of people keep waiting and waiting and waiting. Rebound still wait. Always got a lot of reason and excuses. Okay, so these are the stats. If the market go down 50%, the chances of you annualized return 30% per year, right, happens about 40% of the time. Very, very high chance you make a lot of money. Okay, so you actually hope that the market crash, this time around. If you have cash, you have no cash, then maybe you won't reach the market going down. If you have cash, you really hope the market crash. Okay, so every day you go and scare your friends to go and sell stock. Okay? All right. Okay. And so that is that is my view. Of course, everybody has different views, but I'm just showing you the stats. If the dip has come down, I'm not saying buy every dip. It's not like wow, minus 10% you buy, minus 5% you buy. Small dip don't matter. I'm talking about big dip. Maybe I should change the title. Buy the big dip. Buy the big dips. Okay. So just buy and don't look at it. Right. So when the market, the market 30 to 50% you buy, I think it's a very good levels already. Okay. All right. Yes, China is a big dip now. Okay, but I will share with you about that narrative later. Okay. So the reason you didn't fully invest slightly because you think the prices are coming down, right? That's why you hold cash, because you think you're bearish, right? Okay. And then if the price come down and you still don't buy, then it defeats the purpose of holding cash in the first place. All right. So I always think that if you always want to wait, right, you must be aware that if you want to buy at low prices or falling prices, right, there will always be bad news. Correct? How can price come down and you got good news? Okay. All right. Like minus 50%, then the news still very good one. Unlikely what? So for the price to come down, there must be bad news. Okay, so if you want to buy at cheap prices, you must be comfortable in buying in bad times. That is what it is. Okay. All right. So it comes together. Cheaper prices comes together with bad news. Okay. If you only want good news, you buy higher prices. Right. So that is how the contrarian effect works. Okay. Yeah. So now let's move on to the group that you have fully invested and you have no spare cash to invest. Okay, what can you do? Right? How can you position? First is that you can rebalance your funds. Okay, this is for those who use an asset allocation strategy. Like, you have a very strict kind of a strategic overview how you allocate. Or you're a 40, in US there's this 60-40 portfolio, the most standard portfolio, right? This is just an example. I'm not saying that everyone is like that. Okay, you might have your different allocation. You might add in commodities, you might add in REITs, whatever. Okay, but you might have an idea of what your allocation is. Okay, maybe let's use this example, 60-40, right? 60% in stocks, 40% in bonds. And good friend Keith has shared this in his blog, and I thought that was useful, a research from the Mann Institute, right? Because this year, stocks didn't do well. Okay, bonds also didn't do well because interest rate go up, bond price go down. Okay, and stocks also suffer. So both come down. So this 60-40 portfolio, right, had a very bad year this year. Okay, how bad is it? This is year 2022, first half of this year, performance. It's only 2.3% chance that it happened, but it happened this year. Okay, 5 out of 222 years, and this is the year that it happened. So it's a very rare kind of a scenario. All right. So this 60-40 portfolio suffered one of the worst performance in history over a 200 years period. So if you have this kind of allocation, or likely if you use some this kind of portfolio allocation, right, which advisory usually do a stock bond portfolio, right? Depending how it was structured, right? Usually this year that likely not looking good. That's why I say this year no place safe. Bonds also not safe. Stocks also not safe. Crypto also died. China, US also died. Right? Everywhere died. So nowhere to hide. And you look at the stats also, it's very unusual, right? Very, very extreme. Okay. But here comes the good news, right? The good news is that most of the time when the first half was very bad, okay, the second half become better. Right. So you see, if the first half, 1932, first half was down minus 26% for the stock bond portfolio, second half went up 39%. Okay, most of the time, first half bad, second half good, right? 23%, 12%, 12%, 8%, 8%, 7%, 2%, 1%. Okay, only one time continue to drop. All right. So again, the odds shows that likely second half of this year is also good for stocks and bonds. Okay, because they just suffered a very rare 200-year event. Okay, so if we go back and link it to the market situation right now, right, it also this re-emphasizes together with the midterm elections, all these, right? It shows that this second half of the year might be better than what we imagined to be. Okay, all right. So that's why there will be a lot of stats. A lot of people will show you in the next few 1 or 2 weeks, because we are at a juncture that is neither here or there. Okay, neither here or there. Right. But based on a lot of all these stats, you see is telling you that the second half may not be as bad as what you think it is. Okay. Can So that is one thing, right? So if you are doing this on asset allocation, right, you should still do your rebalancing, because if you don't do your rebalancing, right, you won't capture your capital changes. Okay, so then your investment return will not be as good, right? So I'm assuming if you hold your stock bond portfolio at the start of the year 60-40, right, you'll be the allocation will shift, right? And rebalance means that you must go back to the point of your target, which is 60-40, right? So you should sell a bit of stocks and buy the bonds. So you actually take advantage of the rally, okay, to rebalance the portfolio. So this rebalancing must be done. If you have an advisor or you use robo advisory, they should have done it for you, right? If you are doing yourself, you have to do it yourself. So still must do. All right, don't give up. Okay, because likely the second half is going to be good, right? Based on these stats, right? Based on these stats.